My name is Paul Meehan, and I am president of Edgemoor Investment Advisors. I will be talking to you about how we evaluate potential investments, how we build our equity and income portfolios, and our current outlook for the economy and markets. But first, I want to take a brief detour into the realm of politics and remind everyone of this slide that we have used multiple times over the years. As all of you know, we just concluded a closely contested election, and a new administration will be entering the White House in January. As the slide shows, the long-term trend of the market is higher, regardless of who occupies the White House. To us, this underscores the importance of maintaining a long-term perspective when it comes to investing, and not making dramatic changes to your investment plan based on short-term changes in the political environment. We believe in the American economy and our system, regardless of who goes to work in the Oval Office, and history bears this out. As many of you know, our equity portfolios are focused portfolios that hold 30 to 35 stocks. Our portfolios are diversified and typically own stocks in each of the 10 major industry sectors. Each year, we believe it is important to remind you of the key components of our equity investment approach. Our bottom-up analysis focuses on a company's fundamentals, such as its price-to-earnings ratio, its prospects for growth, whether it has a strong franchise or a wide moat, its free cash flow, the quality of its management, and whether it has high returns on equity and invested capital. These are the same fundamentals that have guided our investment process since Edgemoor began. Many companies with characteristics like high returns on equity and invested capital have a strong franchise or economic moat. By that, we mean that they have a sustainable competitive advantage that protects their profits and market share from competitors. Moats are particularly important to long-term, value-oriented investors like us because they are a critical feature of long-term stock outperformance. There are different types of moats, many of which we have discussed at previous forums. For example, drug companies which own key patents have an economic moat. A powerful type of moat you see in a lot of today's most successful companies comes from creating a network effect. Alphabet, Apple, Microsoft, and Visa, companies we own, have this type of moat. As more people use their services, their advantage is reinforced. They get larger and stronger and have the potential to generate higher profits. Our income portfolios are also focused portfolios of 20 to 30 investments, drawn from a broad range of income asset classes, including utilities and telecoms, real estate investment trusts, energy pipeline companies, business development companies, and bonds and high-yielding preferred stocks. Selecting investments for our income portfolios is guided by many of the same factors as our equity investments, starting with fundamental analysis of individual securities. The most significant difference is the shift in our starting point for analysis, from capital appreciation potential to income generation. Our aim is to find high-yielding securities with strong business fundamentals to support dividend or interest payments. Some of our income securities are structured differently than a typical equity, and so are analyzed using somewhat different metrics. For example, our evaluation of bonds and bond-like preferred stocks means a focus on balance sheet strength and interest rate risk. For more equity-oriented income investments, moats remain an important reference point. Utilities, telecoms, and energy pipeline companies we own like Evergy, Verizon, and Enterprise Products often benefit from an efficient scale moat. This type of moat arises where the cost of replicating a company's assets, power plants, telecom networks, or pipelines, often combined with significant regulatory requirements, is so daunting that it keeps competitors away. We own many companies with economic moats in both our equity and income portfolios. However, we cannot buy every company with a wide moat because some are priced too high. We have to wait until shares of a wide-moat company sell for less than our estimate of their intrinsic value. Despite all our efforts, we do make mistakes. But experience has taught us we don't have to be right all the time to be successful. For an investor, we believe that temperament is more important than IQ. A successful investor is patient, disciplined, open to new information, and willing to adjust her views in the face of changing facts or circumstances. I'd now like to discuss asset allocation, a fundamental decision of investing. By asset allocation, we mean the percentage of assets that are invested in stocks for growth and the percentage that are invested in income-oriented securities. Asset allocation affects a portfolio's long-term total return and its volatility. This is because, over the long term, stocks have produced significantly better returns than bonds, but at the cost of higher volatility. Stock portfolios can lose 20 to 40% of their value in bear markets. And while stocks have always come back to establish new highs, the time it takes them to do so can be excruciating. Stock market volatility is what causes investors so much concern. But if you have a long-term investment horizon, exposure to stocks can significantly boost your returns. Income investments tend to be safer and less volatile and add stability to a portfolio. The majority of our clients want or need some of that stability and have elected to have balanced portfolios. You should be comfortable with your asset allocation and be able to sleep at night. It's a personal decision, and one size does not fit all. Asset allocation is an ongoing process. It changes as circumstances change, as people age, as portfolios grow. Our retired clients, many of whom are drawing down on their portfolios to fund their retirements, typically have a higher allocation to income investments. Another important aspect of portfolio construction is asset location. This comes into play when investors have both retirement accounts, IRAs or 401ks, and taxable investment accounts. To the extent possible, we place income investments in retirement accounts and stocks held for capital appreciation in taxable accounts. This is because taxes on income, like dividend or interest, are deferred in retirement accounts until the funds are withdrawn, at which time they are taxed as ordinary income. In contrast, gains on stocks held in taxable accounts are taxed at the lower capital gains tax rate and are only paid when a stock is sold. Tax-efficient portfolio management is important to us and to our clients. Now, let's take a look at the current state of the stock market. We last had a market correction in October of 2023. A correction is a decline of 10 to 20% from a recent high, and we came very close to a correction in August of this year when the market declined roughly 8.5% from its July peak. Usually the market recovers from a correction within a few months or less. A decline of greater than 20% is called a bear market. On the current slide, the circles show recent corrections in bear markets and their maximum decline. The first circle is the 2020 bear market due to COVID. The second is the 2022 bear market as the Fed raised interest rates to fight inflation. And finally, the third is the 2023 market correction. You can see that in each instance, the market recovered and went on to new highs. Typically, we have a correction about once every year or two, and a bear market about every 5 years. We are likely to have another normal correction over the next year, and we expect the market will recover within a few months as it normally does. We do not currently see signs of an impending recession or bear market. We are well aware, though, that there are challenges confronting our economy and the stock market. These challenges include uncertainty around the precise terms of the incoming administration's economic policies and their implementation, difficult international trade issues, especially our trade disputes with China, lingering inflation concerns, our massive federal debt, and geopolitical issues around the world. Although these threats to our markets and economy remain, in our view, the positives outweigh the challenges facing investors. These positives include, first, economic conditions in the U.S. continue to improve. The U.S. economy's performance coming out of the COVID shutdowns has been the envy of the developed world. U.S. gross domestic product has shown solid growth over the past few years, and that growth is projected to continue. The unemployment rate now stands at 4.1%, very low by historical standards, and wages continue to grow. Consumer spending, buoyed by rising incomes, is strong. Second, economic stimulus from the Inflation Reduction and CHIPS Acts will continue to support growth. These two pieces of legislation, passed in 2022, have spurred a manufacturing construction boom that should lay a solid foundation for future manufacturing growth. Third, Federal Reserve interest rate cuts should be a boon for the markets. After raising rates sharply in 2022 and 23 to combat inflation, the Fed has now shifted gears and has cut its federal funds rate a combined 75 basis points at its last two meetings. The impact of Federal Reserve interest rate cuts on the economy is felt most significantly 6 to 12 months after they have been announced, so it is likely that the economic stimulus from the recent rate cuts should continue well into 2025 and benefit our markets. We are pleased with how Chairman Powell has done his job. It appears he and the Fed have guided the U.S. economy to the sought-after soft landing, raising rates and bringing inflation under control without causing a recession. Fourth, stock market performance is strong. As of today, the S&P 500 is up approximately 25% this year, after returning 26% in 2023. The forward price-to-earnings ratio of stocks in the S&P 500 is roughly 22, somewhat above its long-term average. Corporate earnings in 2024 have been solid. In the past quarter, 75% of the S&P 500 companies that have reported have beaten their earnings estimates. Next year, earnings are estimated to be 15% higher and set another record. Market valuations tend to follow earnings. Finally, and important to us, high-quality stocks remain available at reasonable prices. It is worth noting that the U.S. stock market remains one of the greatest wealth-generating instruments ever created. It has significantly outperformed other asset classes over time, returning an annualized 11% since World War II, well ahead of bonds at 4.9%, cash at 3.8%, and inflation at 3.7%. Today, we can buy powerful, cash-generating companies such as General Dynamics, Johnson Controls, Taiwan Semiconductor, and others at reasonable prices. In our view, these companies are available at a discount to their intrinsic value, and many pay dividends that will grow over time. We expect the stocks we own will provide solid returns over the next few years. That concludes my remarks for today. Thank you for listening.